Welcome back to our little radio show. Isn't that what's his face says? Late Night Live, old ABC guy, been around forever. Back, dear listeners, to our little radio show. Philip Adams, that's him. Welcome back.
Yeah, I love listening to Philip Adams, that syrupy late night voice.
Yeah, I've always sort of thought of myself as the Philip Adams of podcasting, except for the intelligence and the syrupy late night voice.
I was going to say, that's funny. I've never thought of you of the Philip Adams.
A little bit of Philip Adams, a little bit of Roy and HG, a little bit of, I don't know, some idiot. How are you, TK? Basically Sydney's out of lockdown now from what I hear. It's all guns blazing.
Oh, it's a picnic here at the moment. Yeah, it's great.
Literally, you had a picnic yesterday.
We had a picnic yesterday. Caught up with my sister who I haven't seen for over 3 months. It was good.
So that must be a big relief.
But it was good.
Yeah. Oh, good. Well, it's been a rough stretch for you guys. I'm glad I just hope the medical system handles it okay and over the next month or so.
That's the test, isn't it?
Yeah.
Yeah, I'd rather they had that as the threshold for loosening up rather than saying, okay, you're all at 70% first jab, now go and have a picnic. I'd rather them say, okay, the ICU's not turning away ambulances, now go and have a picnic.
I read an article before about some guy somewhere in the US who got turned away he had heart trouble, rushed to hospital, 43 hospitals couldn't take him, and he died. They were just overloaded with COVID. They couldn't get him into 43 hospitals.
Really?
So hopefully it doesn't get that bad here.
Plus he had bad credit probably too.
Could have been.
You seen that movie Sicko?
Yes.
Michael Moore's, yeah.
Yeah, I have that film partially to thank for Chrissy. She saw that film before she met me and decided she was moving out of the United States. And then she met me like a couple of weeks later and thought, he'll do. Free healthcare Australia, let's go.
He'll do, yeah. Grab your coat, grab your hat. You've scored. Let's go.
Hey, I'll take it. Whatever it takes to get me over the line.
What did you say? Who? Me? What? Oh, okay.
No, I said, grab your things. I've come to rescue you. Come with me if you want to live in a country with healthcare. I said. It's been a little bit Russian there. Well, we're going to have a guest coming up on the show today, Tony, James Williamson from Wentworth Williamson.
You sound like Kevin Bridges there.
Okay.
Do you know the Scottish comedian? I've been watching heaps of Kevin Bridges.
No, I don't
Because
know.
he speaks with a Scottish accent, he slows it down. And the famous one is, I hired a personal trainer. He asked me what I ate. I couldn't tell him I had chip butties, so I wrote down avocado. I don't know what an avocado is.
So anyway, James Williamson, well, I read an interview with him in the Fin a few months ago and invited him on the show. He's a value investor, so it'd be good to chat to him. Meantime, the big news for this week, Tony, it was actually last week, but we didn't get to talk about it, is the new theme for the podcast. That's what everyone wants to know about, a.k.a. Tony's theme. I think you mentioned it in After Hours at the end, and then you sent it to me, and I worked it in.
You did.
I liked it.
Yeah,
thank you.
I like the way you skillfully went around my vocals. That's a big improvement.
I didn't want to scare people too much.
No, fair enough.
Yeah.
You know what the recording session was like? Who's going to sing on this? It's like take one step forward. Everyone else took 2 steps back.
Right. And you were the birthday boy, right? So you had to step up.
Yeah.
That's good. But seriously, the big news for us this week is something we soft launched in beta yesterday, which is the Brettolator, I think I'm going to call it. We need a name for it. Brett Fisher, QAV Club member, long-term QAV Club member from Western Australia, and IT Wiz, has been working with you and by himself over quite a few months to develop... What?
Brett, are you sure Brett's from WA?
I was until you said that.
I've got a feeling I met him at a Melbourne dinner, but I could have it confused.
Or maybe he came to Melbourne to hang out. Oh, well, God damn it. Now I have to look this up.
Because I think the Melbourne QAV group had been using it to test it as well before Brett showed me.
God damn it. Okay, Brett from Victoria. Well, when I was setting up, he's going to come on the show next week or this week or something for a chat. And I said to him in the email, so that's Eastern time, thinking he was in WA. Brett from Victoria. I've probably met Brett at a dinner down there too. Sorry, Brett. So many people, so many names to remember. Anyway, back to that. Brett and you have been working together. Brett doing the work, you doing the
supervising.
Testing. Yeah. Developing this 3-point trend line.
bit to the left,
bit to the yeah.
Just write my name on the bottom.
Oh God, I'm going to get this story out sooner or later. Brett developed a 3-point trend line automator, calculator. All you have to do is open up the sheet, Google Sheet, plug in the code of the stock that you want a graph for, and it draws the graph for you, tells you what the buy price is, tells you what the sell price is, tells you if it's a Josephine, plots the graph, shows you the graph, does it all for you, 100% perfectly accurate every time, except for the times it doesn't, because there's a few issues, mostly to do with Google Finance, not to do with Brett's coding, but we'll talk through some of those. But that's the first step, because we know that 3-point trend line drawing has traditionally been probably the biggest challenge that new QAV club members have had. And so good on Brett for stepping up and doing something about it.
It's great. It's a really good product, and he's been working tirelessly on it. We've just been iterating a bit on the rules, and when I've been doing my downloads, I've been comparing them to Brett's graph and then going back and saying, hey, what about this? What about that? And it's been really helpful because it's also helped, just like working with Dylan, it's also helped nail down some of the 3-point trend line rules. So that's been good. But yeah, as you say, we'll get Brett on to talk about it. Please treat this as a beta version, and before you buy something, check out your own, graphs in Stock Doctor or Yahoo Finance or whatever you use, because first of all, it's a Google sheet. So when you get a copy, you save it to your own area because it's a read-only version and the one that we're releasing. But if you save as to your own file, it'll become usable. So that's the first step. Second step is it doesn't handle small stocks very well. When I say small stocks, I mean stocks that have a decimal point in their shares, like if it's 10.5 cents or 40.25 cents or whatever. The Google feed for the stock price doesn't handle the decimal place, so it rounds, so that could be a problem. And what else? Brett's just coded it to receive month-end prices, so if there's a sentiment's broken during the month, it may not pick it up, probably won't pick it up, but that's another issue. And it uses yesterday's closing price. So if you jump on today and want to see if something's, reversed or gone ahead, you just need to be aware that it's not going to pick up today's price. So they're kind of the ones that come to top of mind. But yeah, please treat it as a beta. Feedback, comments on any issues you have or improvements that could be made, and we'll take it from there. But well done, Brett. It's fantastic. I was blown away, and it's been really helpful for me during company reporting season. It's a real good product.
Yeah. And at the very least, when you're using the sheet, when it generates the graph, have a look at the chart and see if it makes sense to you. And then you might want to open up Stock Doctor and compare it there too. One of the other things that we picked up when we were doing the checklist this morning is that it does pick up Josephines, as was a recent thing that Brett added, but he's only looking at the end of last month's price and the end of yesterday's price, and if the latter is lower than the former, it will flag it as a Josephine. However, in some cases we were looking at this morning, the share price yesterday may be the same as the end of last month's share price, so it doesn't pick it up. It just sees it as a flat line. But I think we were looking at RVR this morning, and it was quite obviously a falling knife. The price had been falling consistently since January. So in some cases like that, it's not going to be 100% accurate picking up Josephines and falling knives if the downward trend it goes back further than the end of last month. So keep an eye on that. But, and so, we've been talking, well, ever since we started this thing about one day being able to turn a lot of this stuff into code. And, the work that you've been doing with Dylan and the work with Brett and, the work that Andrew Flitman's done is all helping us start to figure out how to code this stuff. And, we're going to try and hire a team of people to take this and, progress it, come up with more and more sophisticated tools to make it just easier for us and the folks listening to get to a scorecard as quickly and as painlessly as possible.
Yeah, a whole team. We're going to hire legions of coders to do it.
Okay, we're looking for one guy or girl, who's prepared to work
for nothing,
work for likes or clapping or something. I didn't want to be that transparent. I wanted it to make it sound like, we were taking this seriously. But now that you've gone and done that, I guess
we are taking it seriously.
And the other thing I want to point out is we're going to discontinue the shared manual data sheet now that we're putting out the scorecard and you're scoring behind the scorecard each week. We're going to discontinue the shared manual data sheet. If for no other reason, then pretty much nobody was adding to it apart from you, me, and I think Gary, maybe one of two other people. But yeah, so don't go looking for that anymore. I'll take it down off the club member resources page because you've now got spreadsheets again to look at each week. So if you want to see the qualified audits, which is the thing that I mostly use it for, you can go and check Tony's spreadsheet to see if he's been able to find one or not when you're doing your own manual data. Moving on, Gary, speaking of Gary, Maestro now, he posted his portfolio performance the other day, his paper portfolio, I think, as it's tracking in Strawman. Thank you. And he's killing it, 68.6% over 12 months. That's pretty good, Gary.
That's very good. Very good. Well done, Gary. Well done for setting it up on Strawman and well done for having such an impressive result. It's good.
And he was still holding FMG when he posted that as well and still had that result.
Well, have you seen what happened to FMG today?
Not today, no. What happened?
Last time I had a look, it was down to like $14.50.
Wow. I did read that a lot of their execs leaving.
Oh, really? Hadn't seen that.
Yeah, they've had a bunch of execs leaving, something to do with bonuses getting cut or something like that. And they just posted a $14 billion profit, so don't know why that would be. Yeah, so the price has dropped from like $18 down to just below 15. It got lower, but yeah.
Yeah, $14.63 I'm seeing in Stock Doctor at the moment.
Yeah.
Yeah.
68 I've got. Yeah, wow.
So you got to add the dividend back, to take it up to $16.50 or $16.60 or so, but still.
Right.
I hope everyone got out clean.
Yeah. Well, you did give everyone a warning a few weeks ago when we got out. So that was a good call.
Yeah.
What else? MYE had mining fatality last week and the share price took a big hit.
Yeah, I mean, it's always difficult to talk about something like that because of all the personal impacts it has on the people involved. The share price took a hit, but it seems to have flat stopped going down. In fact, I think it was up today too in a sliding market. So I imagine there's some buying coming back. I don't know much about Mastermind other than what I read, and it's a mining operator, a contract mining operator and a contract mining services provider. So basically, providing contract to consult at mines and provide labour to mines. But it has moved into running mines completely for in this case, I think it's an overseas holder. They had a fatality, so there'll obviously be repercussions from that. Pretty hard to know what the impacts will be. There's a couple of things sprung to mind when I had a look. The first one is that they're buying another company, I think it's called Rybar, RYBAR, which is another mining contracting company, and they're going to I think they're either issuing shares or raising money through a share issue. Either way, that's going to be impacted by the price being, 10% lower or whatever it is to what it was like before the incident at the mine. So that might be a risk. Another risk is that they've got 2 of these whole of mine contracts. I think possibly a third coming on, but yeah, it may be difficult for them, depending on what caused the accident. It may be completely outside of their control, but it may impact their work, their ability to tender going forward or win tenders going forward. So in the absence of anything else, there's been no announcement since the initial announcement about the incident, no additional updates from the company, so it's pretty hard to know what's going on. And of course the news has moved on after the initial incident. So, in the absence of anything else, we have to be guided by sentiment, and the sentiment's stopped going down as slightly turning up. So I don't own this stock. I think if I did, I'd be holding on to see what happens.
Yeah, I guess the question I had for you, which I think you've answered, is whether or not it was a bad news sell. I guess it's a different kind of bad news.
Yeah, it is. It's a different.
Well above I was going to say it's well above its sell line.
Yes,
but it's not like the CFO suddenly resigned or the CEO suddenly resigned.
It's also not like from day one, people came out, like the mining union came out and said, it's all their fault. They've got a history of bad management. They were cutting corners. They were, working people too hard. No one said anything like that yet. So it could just be an accident. So, yeah, we just don't know.
It was one of the better performers in my portfolio up until it plummeted last week. It was up like 20-30%.
Right.
Then it dropped. It's back up above water. But anyway, yeah, it's very sad for the families involved. ZGL price update, Tony. So we very bravely put ZGL up as our first stock of the week back on the 7th of September when it was at 12 cents. It's now 10 cents. What do you have to say for yourself?
It wasn't our first stock of the week. It was our first stock of the week that we started using after we had got the AFSL license. AFS license, yeah. What have I got to say for myself? Nothing to see here.
Right. Move along.
Move along, yeah. So look, it's down 2 cents a share. It's a small stock. It's very illiquid. It dropped and then it stopped. Nothing's traded for a while. So that's the way these stocks work. The thing I think it looked like that it may have dropped those 2 cents, which, admittedly it was about 15% based on the share price. I think it was like 11.5 or 12 cents when it dropped. So it's a big drop percentage-wise, but not much in terms of cents. But we recommend, in retrospect, shouldn't have recommended it before it released its annual results, which came out like a couple of days after I recommended it. But that's how I do it. Oftentimes, if they're good on the QAV checklist, the results come out and the share price goes up, right? Didn't in this case because the company had a loss. Went from a profit to a loss. However, drilling into it, the operating cash flow generated by the company is still very strong. In fact, I think it's even a record half for it, which is why it scored very well and still does score very well from a QAV point of view. But they repaid a whole heap of debt, like about $17 million, I think, from memory, which is why they declared a loss. So they basically used their record operating cash flow to pay down a whole heap of debt. So, I'll give it a leave pass on that one. Even though it's a loss, I can understand why.
Mm-hmm.
Yeah.
Okay. So
we'll hold. We'll see what happens with its share price.
Okay. CVW. We were talking about CVW. I think it was your pulled pork recently. And then Murray on Facebook pointed out, who I can confidently say is in WA.
Yes.
Murray pointed out that the figures in Stock Doctor were incorrect. You've looked into it a little bit?
Yeah, looked into it a little bit and also spoke to Stock Doctor. And Murray's right to the point that I think it affects the P&L part of Stock Doctor. So what Stock Doctor have told me is that because it's an insurance company, which is a bit different to most other companies, that some of the wires got cross-loading the P&L items into from their data provider into Stock Doctor. They'll fix that, but they have advised it may take 1 to 2 weeks. But, looking at it to reconcile it myself, the cash flow report still reconciles properly, so those figures are good. So I don't think our QAV score will change very much once the figures are actually righted by the data provider to Stock Doctor. But, right. It does look a bit funny at the moment. PE looks wrong. So the score may bounce around a little bit, but the price to operating cash flow won't change, which is the big driver for the QAV score, especially in a stock like this.
Mm-hmm. Okay, well, good pick up on that one anyway, Murray.
Yeah, thank you, Murray.
Now, Duncan sent us an email with a bunch of graphs to check. This is before the Bredelator came out, and and
you want a byline? Talk to me, the Bredelator. That's Mad Max, sorry. Not the Terminator.
About 3 miles from here, I saw a rig that'll pull that thing. Tanker, you want to get out of here? You talk to me. What a great line. Duncan sent us an email with a bunch of graphs, and I reviewed them and agreed with his call on some and disagreed with others, but then I sent it to you and you shot me down on some of them. It was in a nice way, in your own nice way, but it was a real education that I still got a lot to learn about doing 3-point trendline graphs. But now I have the Bredelator, so yeah, that's one problem solved. But can we talk about a couple of these? Because I just want to see your thinking on this. First, let's have a look at KPT. KPT, baby, you know me.
Kangaroo Island Timber from memory.
Yes. Now, this one is one of these weird-looking charts from memory, and I think we've talked about it before on the show. It's basically had a flat line basically since, March 2017.
Yeah.
It was trading at $245, and then it dropped to a nice round like $2.36 and has stayed there ever since. Now, I mean, why the hell you would buy that, I don't know. But you said something happened and we have to look at a shorter time frame, right?
Yeah, so I don't know what happened, but something happened. It may even have just been some kind of share split. I know in my research for the company, certainly it wasn't as far back as 2017, but this is Kangaroo Island Plantation Timbers. So it's obviously a timber farm and sawmill, and it was wiped out in the bushfires, 18 months ago now. So it has basically, I was going to say sprung from the ashes, but that's a bad pun. It's pivoted. So they're not going to try and replant the plantation timber. I imagine that would take them many decades to get that back. They're going to pivot to an agricultural company. So I don't know if it was something like that caused the big sell-off in 2017. That would have been before the bushfires, but perhaps there was something else that happened back then of a similar nature. But anyway, the share price was either restructured or there was a big sell-off. And then again, since then, there's been the issue of the bushfires. So if you look at it from on a 5-year graph, all you see is a flat line, as you said. But if you go back and look at it on a 3-year graph, which is an option in Stock Doctor, it starts to make sense. And you can see that, again, it dropped down in September. The high point was September 2019. Low point was June 2020. So I imagine, and there was a big drop from around February 2020. So that would have been the bushfires, I guess, wiping out the plantation. But since then, they've done a fair bit to try and pivot the company to being an agricultural company, and the share price is starting to increase from there. The low was at 8 cents. Is it? Yeah, 0.8 cents of a share, and it's now back up to it's 80 cents a share, and it's now back up to $1.17.
So the lesson here for me is if I see something that looks weird, like the KPT anomaly, the big flat line, instead of just going, I should stop and think. Why does it look like that? And, do some more work.
Yeah, I mean, just from my experience, if you see that kind of graph, go to a 3-year one and see if there's a better graph to work with, because something's happened in the longer term.
And that's allowable under QAV, is to look at a shorter time frame.
Yeah, well, 3 years. 3 years is still a long time frame. We're still using a monthly graph, and it makes the whole thing much clearer. It better reflects the situation for this particular company.
Yeah. So something dramatic happened, and the company is a different company today to what it was before the plummet.
Correct. Yeah.
Okay. See, always learning, Tony. I'm always learning. I'm slow, but I get there.
Slow? You're a Terminator, mate.
Yeah. Well, that's it. I'm the slow Terminator. I'm not like the T100 that's just or the T1000 where it was just I'm the slow version. I'm like Arnie now as the Terminator, like I'm in a wheelchair Terminator, slowly making progress. There was a couple of others here that was interesting. RVR we've already talked about in a way, but WMC, this is another one where you wanted to unflatten the prices. And I know we talked about this on the show just last week. Steve asked about it. We thought it was Western Mining Corporation and it wasn't.
Yeah, so again, a case where you need to use the 3-year to unflatten the graph or to make it more useful.
Yeah.
Yeah, so it's been on a long, steep decline for quite a while.
Yeah.
And, so actually in this case still use the high point from 5 years ago. In fact, I think I did with Kangaroo Island too. But, if you just look at the 5-year graph, you can't see anything to put to anchor as H2. So I dropped back to a 3-year and you can see that, again, around the low point was May 2019 and that was at 70 cents and it's now back up to $1.02. So there has been some growth since then. And you can see it if you go to the 3-year line.
What are you using as H2 here?
Yeah, so this is a case of, the buy line following the sell line. So it would have been a sell. So the L1 is May 2019. The first time L2 would have been used would have been March 2020, which would have made it a sell around February, or maybe even January or February 21. But I can get a buy line after that using the July 2021 peak as the H2 peak. And
where does the Brettolator put this?
Oh, I don't know.
Just bringing it up.
So Brett's got a buy line much earlier than me, but it's in a buy situation according to him, I think. What's he got? Yeah, he's got a sell price of 95 cents and it's currently $1.02.5.
Okay. So again, the lesson is to just think, drill down.
It's just experience, really. The lesson is you'll know this after a while that you'll see these stock graphs that fall off a cliff 4 years ago. So use the 3-year graph to see how it's going.
Yeah, right.
Mm.
Okay. Well, that's
right.
That's good. Yeah. Let's move right along. You want to talk about corporate tax? We've got about probably 5 minutes before James is due to join us.
Okay, so just run through a few things then. Corporate, so we were talking before about the Buffett ratio and how I was saying that it should be viewed these days through the lens of low interest rates and corporate tax rates, because corporate taxes were lowered under the Trump administration. There's now a bill before Congress in the US, which is the $3 trillion odd infrastructure bill, but it also contains a corporate tax rate hike, which isn't receiving as much press over here as the $3 trillion infrastructure spend is. So I guess the upshot is I think Goldman Sachs came out and said that if the bill got passed, they think it would decrease corporate earnings by 5% next year. So that's going to be a hit to the market. Obviously, if earnings go down and the PE ratio doesn't go down, doesn't change, then the share price will drop. So I just wanted to mention that might be another factor to take into consideration when we're thinking about the future, that corporate earnings are probably going to drop in the US regardless of how well they do. The other thing that came out in the last week or so was US inflation numbers, which were north of 5%, and expectations of inflation, which is another survey that they do of consumers, is expecting that to get worse in the next 12 months. So there's a big debate going on around whether or not inflation is temporary or whether it's entrenched. Certainly the consumer thinks it's entrenched, and sometimes these things are just perceptional. So if the consumer thinks inflation is coming, they may well try and save more and spend less. They may bring spending forward to try and buy things now before they go up in price, which means that they're short of cash in the future. But there's a few sort of things going on here which aren't pointing towards a bright future, I don't think anyway, necessarily going forward for the share market. Don't want to be a harbinger of doom, but these things are going on in the background that we should be aware of. A couple of other things that happened during the week. We spoke about coal and uranium last week and how their 3-point trend lines are going up, which they are. One of the commodity stocks I didn't talk about last week, which had been on the buy list up until a little while ago, I think perhaps even up until its last results, which caused the share price to improve, is South 32. S32 is the code, which does have coal mines in its portfolio, but it also mines, they call it alumina, but I guess it's bauxite, and lead and zinc, and all four of those are going up at the moment. It's off the buy list now. It's got a QAV score of 0.07 the last time I had a look, but people might want to, and I own it too, so don't necessarily take that as a recommendation, but if there is a bit of a period in the market where it does downturn a little bit, this one might come back on the buy list. What else do I want to say? Did want to talk again about Apollo Tourism and Leisure, not continue to poke the pig, but I didn't mention when I was talking about Apollo Tourism and Leisure last week that it has a shareholding in a company called Camplify, which listed on the ASX and has done very well since listing. And I think Apollo Tourism owns about 17% of that. So that will certainly help their share price going forward too. So that's just apropos of our general discussion about Apollo last week. What else in the company roundup? Myer is profitable again, but their numbers aren't in Stock Doctor yet. So it'll be interesting to see what happens to their QAV score when those numbers get loaded. Midway, MWY, has been on our buy list. I actually removed it during the download over the weekend. And Midway, for people who don't know it, is a relatively small wood pulping company in Geelong in Victoria. So I'm not exactly sure whether it has a plantation, but it certainly takes logs and pulps them and then sells the pulp to paper mills. It seems like when I did a bit of research into the company, because I did recall reading some articles about lumber prices in the US dropping dramatically. They had been going up quite strongly, but now they've dropped back. It turns out that there is a lumber graph in Stock Doctor. I'll just call up and get its code. And also
hardwood graph.
Sorry?
The hardwood graph.
Hardwood, is it? Okay. Do you have a code for it?
No, but we were looking at it this morning.
I'll just call it up so I can tell people.
Hardwood and softwood.
Well, that's an Index Mundi. Index Mundi has sawn logs for hardwood and softwood, and their 5-year graphs are all sells at the moment. But there is also, if you go into Stock Doctor, and just as we would for other commodities, we can look up, there's a lumber futures, LB hash is the code, and if we use that, that's also it's gone past its sell line, but it has turned up, so it's still probably 100 points away from its buy, but it's below its buy price at the moment. So I've taken off Midway. I've said it's an underlying commodity sell based on the lumber futures contract, and there's also another 4 of those versions of that in Index Mundi, but they're all in sell situations. But we'll have to monitor that one going forward. A couple of other quick updates. SRG breached its sell line for anyone who is interested in SRG. And then there's one of the companies on our buy list is Mineral Resources. And I've put a question mark onto the buy list. It's a Mineral Resources is part iron ore. And like I said last week, I don't really have experience with these sort of diversified miners and whether we should take them off. Oh, that's right. The thing with Mineral Commodities is it's also a mining services company and provides crushing services to other companies from memory. So it's not just in the commodities game. But most of the profit in the last year has come from commodities, something like about maybe 3/4 even, 2/3, 3/4. And if I have a look at the commodities, it's gold and lithium as well as iron ore. So there's a couple of those which are not in the sell category, even though the iron ore is. So, I'll call it out. I'm not going to sell it yet as a 3-point sell, but the price has retreated. So maybe I should be taking these diversified miners and selling them based on the iron ore price. If I know we've got some people in WA with mining experience, I'd be interested to know what they think on these diversified miners. And then the last thing I wanted to talk about, Cam, I know it's probably getting close to the time when our guest arrives, but I just wanted to mention my personal returns, because I know that we always talk about a 19.5% return over 25 years. Well, it's probably about 27 years now, probably. since we started doing the podcast. Anyway, my returns have dropped back to 19%. I just wanted to highlight that for transparency, partly because of the hit that a large part of my portfolio took when iron ore stocks started to decrease before we sold them. So I think Fortescue dropped from like $25 or $26 back to, I sold at sort of $20.50 or thereabouts. And that was a large part of my portfolio, as was Champion Iron was in there as well. So, and plus, I'm living off the dividends, and so I'm not reinvesting them the way I was now that both Jenny and I aren't working. So I just wanted to call that out. I point out a couple of things. I didn't call out last year when it was above 19.5%, but I did want to call it out now. And secondly, over that same time period, which is a long time, the All Ords Accumulation Index has done 7%. So it's nearly triple. I know we talk about double market, but in this case, it's still, even though it's fallen slightly back commodities route, it's still nearly doing triple the All Ords.
Okay, good. Well, thanks for the transparency update. I'm not sure there's much difference for most of us between 19 and 19.5%, but as long as you feel good about getting that off your chest. Well, welcome to our guest this week, James Williamson from Wentworth Williamson Management. I've got you from LinkedIn, James, listed as Founder, Executive Director and Chief Investment Officer. On your website, it just says Fund Manager, so you're obviously very humble when it comes to how you present yourself on the website. I read an interview with you in the Financial Review, I think back in June, that I really enjoyed. I thought, he's one of us. I need to get this guy on to talk about value investing. So welcome to the show, and thanks for taking the time to join us. Where are you based, James?
So we're in Sydney. You're a relatively small team. We like to stay in the little hub of Sydney. You get that little square.
Are you enjoying your new freedoms in Sydney? Are you getting out and having picnics and stuff like Tony did yesterday?
Yes, I'm lucky. I live in Manly, so I try to get out and have a swim each day. And so getting to the ocean and, you're on your own out there. So it's fabulous. So definitely, I think, looking at Manly and just looking outside too, you can see you can see in people's faces. They can, they look a little bit better. There was a time there a month or so ago, people looked a bit down in the dumps.
You're not supposed to see their face, though. They're meant to be wearing masks, but anyway.
Tony Abbott, there's so many other people walking around without their masks.
Yeah. Well, let's start with a little bit of your background, James. Judging from the accent, you're not from around these parts.
Yeah, that's right. So I was born and did my understudies in South Africa, and I went to London where I met my wife. And I arrived here in the late 90s, and I worked for a group called Mercantile Mutual Investment Management. You may remember them.
Mm-hmm. I do, yeah.
So there's some well-known figures there: David Paradise, Peter Mowat, Johnny Morgan, Greg Matthews, a bunch of guys all went and did different things afterwards. It was a nice lesson. The late 90s is a little bit like I see things now. And they ran a GARP process, growth at a reasonable price. And when you're a big fund, you've got to have a process. When you pretend to everybody that it's always going to spit out the right answers, and of course it doesn't in different environments, and it certainly didn't when things changed. So it was a very nice lesson for me. There was a gentleman there who taught me a lot, the late Raymond Levinsky, and I knew what I was and what I'm not, and that's half the battle here. And so my career went on from there, but I moved to other countries for quite some time before coming back here.
In the Finn interview, I read a great line from you. You said, in the late 1990s, I was watching the late Simon Murray, I think it was at Alan Gray, when they lost all their clients bar one. And I was thinking, man, I want to do that. I want everyone to dislike me and then be right. Is that what it takes to be a value investor, James?
Sometimes I'm too honest and I just call it. But there was those days because when I moved back from Australia to South Africa, I moved from the buy side to the sell side. And, of course, all this played out. You remember we had the Asian crisis here, which impacted Australia, and then we had the Y2K and the tech bust. Mm-hmm. But I saw these guys back then, and so they were going bankrupt, and all their clients were leaving them. But I also see them sticking to their guns, what was sensible. And I have to say, as a young analyst, as the stocks were declining, I would use a different methodology. I would say, I used to pretend to myself I could do a 10-year plus DCF back in the day, and then I was doing PEs, and then eventually I was doing price to book for a retailer, so I was pulling out all the tricks out of my toolbox to explain the price. And the sell side analysts do this. I don't blame them because they have other pressures, but I did it too. When it starts to go back up, then you find a reason to explain that price. And so the circus continues. But I did a bit of this, but I did see these guys and I quite admire them. And I saw it all through in quite an extraordinary time. And I was like, no, I know what I am. I can't do this. And I was made. And although I stayed on the sell side for quite some time, and in South Africa, I started to cover luxury goods overseas, Richemont and LVMH, and then I started covering global beverages, and the next minute I was in London running global beverages because the head of research was a French guy, and he said, there's no way, it's probably right, the South African can cover luxury goods. I think he's totally right. I stuck to a very value-based approach, which means trying to look ahead over the next half or the next year's earnings. I really was trying to think who's better positioned over the next 3 to 5 years. It is quite rare. We've been pushed into be more and more short-term focused. I would say now more than there ever was. But it was definitely prevalent back then. And with sales teams dictating where the money goes, you can see why that happens. But that definitely shaped me. As I said, the late Simon Marie, I actually ended up working for him. And he was quite unrelenting in what he believed was right and what was wrong. And that also brings you down as a value investor. Sometimes you have to stand up. Uncomfortably, nobody likes conflict, but sometimes you have to stand up and say, this is wrong. I find that's also been lacking this last while. So I learned a lot from him, but I've got my own business now. Actually, his son works for me, which is a nice touch. Continuing on. And of course, I feel a little bit like they did in the late 90s because we're there. And I think this is the late 90s, but on steroids really, because we haven't just had this growth bias, which has been quite extraordinary. I mean, you just run through some of those companies and, they are a long way from making proper cash flow. And also you've had this huge prevalence of index funds, which is money, and it's money pouring in. And of course, it's a lot of retail money too. We know that's history too, but that's also pouring in. So I can move around quite a bit, but I find that slither of the market that's just outside the index hasn't seen that. So give you an example like a Surf Corp, which I think he's good. I think Alf, whatever you might think of him, because he's quite a colourful character. He's built an extraordinary business that's incredibly resilient and probably best in class in the world in what he plays in, but it's not caught up in those index flows. So I think if you look there's a couple of reasons why it's not in the index. One is because you own so much of the stock, and there's pros and cons on that. But I think there's a slither that's still value. I say myself, it's not easy out there. You have to really nitpick because a lot of it looks a little bit heated. Especially if you want to go normal multiple, normal margin, just apply simple things. It's hard, because multiples have gone up and some margins out there look like they're elevated relative to history. So if you apply some simple value investing principles, it does make it quite difficult.
But this time it's different, James.
Yeah, I have been told that. We printed that on our coffee mugs, James.
Yeah.
No, it's not.
Yeah. Look, what the thing is, which concerns me, nobody likes a credit crunch because that is very serious. And we had elements of that in early 2020, right? The beginning parts felt like a bit of a credit crunch could be on its way, and there everybody loses. I think the best scenario for us is some of the heat comes out of these overheated areas, or just flat, and in real terms you don't do a hell of a lot for quite some time. And I think that's going to come as a shock to some people because they've done so well just following the normal trends or buying bigger stocks. It's been seemingly easy, but if you go back in time, you can lose a decade. I think we're probably heading somewhere there. I actually feel that inflection point was probably late, almost that last quarter of last calendar year. It doesn't feel like it because you had these swirling winds all the time. But I think if you look back, that could have been a bit of an inflection point, but time will tell. The reason why I mentioned the credit crunch, of course, is because there's so much debt out there, it's frightening. And eventually this, you got to pay it back or you accept much higher inflation. No, that's real. That's the two things you're going to have to face.
And potentially higher interest rates as well.
with that will follow later.
Yeah.
100%. Can you imagine?
Oh, I don't have to imagine. I've been there. I've lived through it.
Yeah.
It's not pretty.
It's not pretty.
First house I bought was on a mortgage with 15.75% interest on it. And that was the lowest in the market. So, yeah.
If you say that to young people today and the pressure for them or the FOMO to go get their first mortgage is so extreme, and what they're saying is, no, I'll be okay. But what if it goes up 1% and you're not okay? And they say, oh, no, I'm going to be okay. I'm going to win more money. I'm going to have bonuses. I'm going to do this. They don't know. There's no safety net built into the budgeting, right? If there is budgeting going on, which
right, yeah.
I doubt.
Yeah.
So
what happens if the wife has a baby and there's one income coming in?
Somebody gets sick. So in those days when interest rates were high, and I remember in South Africa too, they were double digit. My first house was also the same on those sort of rates. And they used to budget properly because, you used to move around too. So it seemed to have gone out the window a little bit.
Yeah, I noticed when I was reading your bios and the articles you've printed, not only is your style value focused, but it's also contrarian. Maybe you could tell us a bit about why contrarian and what's an example of that.
Well, we're already quite a rare breed, aren't we? So contrarian is I'm always interested in something that's hated. And this flies directly in the face of this last couple of years of what we're seeing. The more it's loved, the more I'm like, I don't want to look at it, because it might go up a lot from now, but the chances of it being good value are probably pretty slim. And there's guys who are good at popping on and hopping off and all that. That's fine, but real value is probably slim. But if it's really, really hated, sometimes, not often, but sometimes there might be something interesting there left when it's a fraction of what it normally be almost, And I've got some examples, things that were in the ASX 300 at one point. They were those stocks that I see in there today, and there wasn't really much of a business model in there. They certainly weren't generating cash flow, but there was some sort of hype. And years and years and years and years later, when they've fallen to tiny market caps, when they've finally started to sort themselves out and there actually is something there, they're starting to make a little bit of money or very close to, then that is nobody's interested. And you almost got to relaunch yourself in some respects to get yourself going. But if there's something, good IP in there or good people in there, because it's normally a journey, these things, then the phoenix can rise again. But it's tough, that one. But we definitely have a look. And I look at it in reverse. So I remember chatting to some financial advisors that, sometimes they run their own stocks and they go, get all the brokers, so buy, 7 out of 7 of the brokers coming to stock say it's a buy, it must be a buy the stock. So I think that's a terrible way to invest. Actually look at it in reverse. Actually, if they all sells and they all think it's the end of the world, and I go back to my history and how analysts think, well, if they all sells and they've slashed their prices and everybody's embarrassed and they've done so badly and God, the salespeople are giving them a hard time, go look there. You should probably hunt around there. You've got a better chance. You just don't invest for the short term. Think 3 years, just in case. Sometimes they run faster than you think, but sometimes it's 3 years. Just so you get your psychology of your brain right.
How do you approach the psychology of buying a stock in that situation, but then it goes down lower, or it takes 2 years out of those 3 years to come good again?
So I think that's what comes down to backing your due diligence or your research that you've done. The complete opposite to what I'm saying is you hear it from a mate in the pub and the stock goes down and you don't like the guy anymore and then you sell your stock at a loss. You've done no work. And so that should really bother you. Me doing work and understanding the fundamentals go down, typically I buy more. It's a horrible feeling that if after 3 years you think you've made a mistake. That's different, and hopefully you make few of those. But I have made mistakes. But most times, if you've done your work, your homework properly, you're going to be okay. Sometimes, and I hope that's also rare, sometimes you have to do more work in it than what you expected. Like real work. Put people on the board, get a little bit more involved. But that also means that you've misjudged something, but it's fixable. And the worst case is you've just made a total mistake. And that's not nice. But I would say by far the majority of the time, these things turn. And all of a sudden end up in market darlings yourself. And you're like, okay, I've sold, made good money. It's gone up 100% again. And you can't understand it, So the sentiment seems to shift quicker than you think and quickly.
What would be a good example of that kind of turnaround that you've been through?
Oh, well, there would be plenty. I mean, I remember I was buying Worley at one stage at $3. I mean, it was a darling. Then it got, it was totally sold down. Then it went back up again, and now it's time to have another look. Would be an example of that one. But, if you run through the portfolio now, one of our bigger holdings now, Fleetwood would be one. Used to be in the ASX 300, used to be a $12 stock. That's Sea Ripple. It's got 3 divisions in there, but Sea Ripple, if you look through its history, it's got 35% occupancy rates here. If you go back to 2012, much higher occupancy levels, 80%, used to generate $50 million. Today it generates $10 million EBIT. They're there. So should you have held it when it was $12 running at that sort of over-earning occupancy levels? No. Should you be looking at it now when it's low occupancy levels? Definitely yes. So that would be a bread and butter investment for us. It's got $60 million net cash, which is roughly 20-odd% of its market cap. It's got 20-odd% of its market cap in franking credits. 3 solid divisions in there, all making money, trading on 12 times earnings, and can grow, especially with the modular building business and the Sea Ripple sites. And of course, I'm watching this Scarborough FID on the Woodside very, very closely, because that's important for that. I also own Woodside, so we're a bit long oil. And of course, I own MRM Offshore, which has also been a journey. Mm-hmm. I mean, that was $1 billion company at one point in time. Also very much loved. It was trading on high earnings multiples on peak margins in a very cyclical energy industry, and did a huge acquisition at the peak and took lots of debt. It's almost like committing harakiri. But today it's the complete reverse. Its margins have been as low as you've ever seen in this industry ever, trading on a third of its tangible assets, which have been written down, about the newest fleet in the world. And looks like there's a couple of FIDs in our region on oil and gas. But of course, you've got this wind projects coming up too, which are just as good. Offshore wind's a huge thematic, and that needs to be serviced too. Again, you've had these companies that were stars at one point in time, very prevalent in portfolios, and got sold off and forgotten about completely out of the index. Clearly, I'm hoping they will rise again and get back in and attract those kind of people again. And then I'm happy to say goodbye. The opportunities are there. I just think in this environment, you're just forced to go deeper. Other than oil, which I think Woodside is a genuine opportunity in the large cap space, I think, and some of the oil guys, I think you just have to go deeper. It's just the way it is.
So what kind of metrics do you use to do your valuations? It sounds like it's a whole suite of them rather than just, price to book or discounted cash flow.
So one thing we're not generally is, I can do this job for hopefully still quite a long time, but I hope my companies make cash flow in that time. Some of these entities I see out there, I think you're just dreaming. Everything has to go beautifully to reach these valuations, and value guys are not that. You can square away a lot of the market just by saying that. I'm going to use the word normalized earnings, because a lot of these companies have histories. And so on a normalized earnings margin for what they do, I want to be paying about 12 times earnings, 10, 11, 12, 30. Those are my numbers I'm comfortable with. I don't want to be paying 25, 30 times these kind of numbers, because a value guy looks for cash today. He plays less focus on cash that's in 10 years, 12 years, because we know, and can see you've been around long enough to know that stuff happens in between now and then. And so I want cash today. I do have a good look at the balance sheet, and for various reasons. One is I am a little bit scared of too much debt. Whenever I've been completely carved out, it's because there's of debt. So I'm careful. And if there's a good tangible asset backing, I'm thrilled. It doesn't always be like that, because it depends on the business. But if there is, it just makes me feel happier. That's not to say I look at that and say, well, if it all goes pear-shaped, I'm fine. You'll still lose money, but you have some sort of safety net at least. But I would say that a typical value guy doesn't want to pay too much today. He would place quite a bit of emphasis on the balance sheet. And some of us, the traditionalists, prefer lower gearing levels, some sort of tangible asset backing depending on the industry. And the way I rationalize it, and I think many of us do, is that our rationale is our downside's also lower if we get it wrong, which from time to time happens. Your real downside, where you actually have to, when I made that point about sometimes I've made a mistake, that's real risk. where I actually crystallize a real loss.
Well, it happens to all of us. Not even Buffett gets more than 6 out of 10 right, so it's going to happen.
I agree, more or less in your percentage. I think if you get 6 or 7 out of 10 right, I think you're doing well. During this time, as a value guy, clearly, obviously, has not been an easy time, especially in the area where I've been hunting the most, because I started looking there very actively 16, 17, because you could see the flows. A lot of my peers went bankrupt, but you've carried on for several years.
How important is management to you? Do you interview management? Do you sit down with them, try and judge them somehow, look at their plans? What do you do there?
As I'm getting older, you realize how important it is, but it's hard. I don't need to tell you that. I had this one CEO I backed, did very well, backed the same CEO in a different circumstance, did terribly. It's sometimes hard to go back through someone's history and say how much was luck, how much was bad luck, how much was they generally good. So there is that, but yes, it makes a huge difference to find that right person. And, I've experienced some excellent managers, but equally there's been times where I thought, oh my goodness, how did this happen? And also, you look at the board, and sometimes you look at, just to make sure, is this board things go awry? They're strong enough to, but, I've been surprised there too. But it's a crucial thing to look at, and yes, we interview them 100%.
In terms of value plays, would you ever look at a growth company that was depressed? Like, at the bottom of the COVID outbreak, companies like Afterpay were down to $20 a share or whatever. Would you ever look at buying something like that, or are you just strictly looking at cash flow?
So the answer would be yes, I would look at it. Afterpay have done a brilliant job. Full credit to them. I never got those anywhere near those valuations. I think a lot had to go right, and I think that they've to some extent been bailed out here. Don't want to talk about Afterpay anymore. You have to assume a perfect scenario for next 15 years to get to those numbers. But yes, there was. I've got a position in our fund of a business that, in my mind, is clearly a growth stock, and it was backdoor listed, had all the hype with ASX 300 on the chemicals, fire retardant for the US Marines. They were nowhere near there back then. Absolutely not. Now it's a tiny little business. I went and had a good look. I sent a consultant to the US to have a look at them. By that stage, they'd moved their chemicals into the bedding industry, and, who does that? It was a 50 million market cap company, and I sent somebody there for 2 weeks. But I managed to verify it. They've had real IP in phase change material and fire retardant. Phase change material was their first revenues, which means they're cooling chemicals in some big retailers, in fact, the biggest in the US on the bedding industry, first of all. And it looks like now, after 2.5 years of hard slog, go recapitalize that business and put some people on the board. And as we sit today, they're moving into different verticals with different players, taking that coolant to ballistic vests and into, heading into sportswear. And now looks like in the bedding industry, the sock on the bed, moving with fire retardant and also working on various textiles fire retardant. So there was nothing in that business when it was an ASX 300 stock, literally, because I went back and I had a look at some of those things that were said at the time, and I'm like, my God, how did that happen? But I look down where it is right now and I'm saying, okay, and you start doing the right thing. You get a proper board, you've got proper revenues, probably now going to, we're talking about a quarter, probably making money, some nice contracts sitting there which are imminent, and now it's a proper thing. And it's got proper IP into two very big categories and topical categories, and also moving on the eco side, taking formaldehyde out of chemicals, which is going to get legislated out. But other than, some rats and mice faffing around, it's just, it's a little bit lost, but that's fine. As soon as you start, you need to consistently kick your goals and you'll be found and off you go again. But I've played quite a big role there. And sometimes I wonder, well, was it worth it? I'll tell you in 5 years' time. It's been a lot of work.
Which company is that, James?
It's a company called Alexium International, and really it's about 20 odd chemists or scientists that sit in Greer and South Carolina. It's listed here. It's a complete anomaly. I think for the average guy to go verify all of that is next to impossible. And really, if you've done all that damaging thing in the past, even though it's real and you say it now, people don't tend to believe you. But they're starting to whack out some decent sales number. Very recently starting to all come through. So I think that counts. And I think that they're starting to get noticed again. But they just got to keep on delivering on the numbers. Then I actually don't really care. Just keep on doing that. It's a strange thing. I don't really want it just to run up higher than what it is. To have this ginormous thing. There's a part of me that just wants it to be the share price to move sensibly, and then building up as they earn the right, have the right share price. That would be my preference. If it spikes up and gets stupid, I sell it, I make a big profit. But there's a part of me that thinks, it doesn't feel right,
Yeah. I know that you've taken positions in uranium, which is something that we've talked about on this show recently because it's starting to spike up. Is there a risk in being too early with an area like that?
Possibly. I don't think we're too early. We put our position. We sold out, by the way.
Okay.
We built our positions in 2019. We just thought it was that point. I know it sounds crazy now because these things are on Reddit and meme stocks. Like it's attracting all this hype now.
Yeah.
And I'll explain afterwards why we sold out. But back then there was none of that. I was almost embarrassed to say that we were in uranium. It was like that, just this value guy again, Yeah. Value is almost a dirty word for not performing, The value guy buying uranium. Why are you buying uranium? Everybody's buying this. Why are you buying something nobody wants? In our mind, in our fundamental mind, it was just a matter of time before some of these guys were going to get contracted. In my mind, it was a 5-year play. Honestly, these things take longer than you think. Luckily with uranium, there's quite a bit of data out there. So I was pretty confident that they had to start to re-engage in a reasonable period of time, which is in my mind 5 years. But the market always anticipates a little bit earlier. So that was also in my mind. So we started to build positions. Now our mandate, which I need to look at, is only to invest in Australia and New Zealand, which is quite problematic when you want to go to uranium because you're buying juniors. Some guys haven't even got it all set up to be miners yet. They've still got to jump some hoops. So you're buying the stuff in the ground. It's not even getting mined. So Paladin was probably the best out of there because of the history, but there's some good guys there, Boss and Vimy and so forth. But there's a lot to do. Let's make no mistake. And so I decided that I'll buy 5 of these things. And I expected capital raises, which there were. And you take small position in all of them. As they come, you go. You prepare yourself for this journey. What I really wanted was Cameco. The low-cost miner. There's 2 low-cost guys, Kazakhs and Cameco in Canada. I really wanted Cameco, and I would have got a lot bigger. So I built this up to 5% in our fund, but really if I could have got Cameco, I would have got bigger because I saw them as much lower. They were low on the cost curve, a proper established mine, making cash flow, strong balance sheet. But I had to do with what I had in front of me. And our target prices were on contract prices, which we thought were possible, and putting a reasonable guesstimate on a DCF on there. There was no way around that. That's how you try to come to your, and I'm telling you now, these prices are nowhere near what I think are reasonable contract prices. But I look out for those guys. I'm wrong, but I don't know what people are tapping into their models, but you have to put in pretty hot prices in there to get to these other prices. So it's clearly become a trend. And it fits a thematic.
Yeah, it has.
And when you fitting people's thematic on how they see the world, it can go anywhere.
The ETFs, which are popping up to buy uranium and hold uranium, is doing that to a large extent. But and I just wondered because, as you say, however many years ago when you first started buying uranium, no one was talking about uranium.
Tony wants to know if you watched the rugby on Saturday night.
I did. My wife and my children are Aussies, but it's very hard for me to not support the Springboks. So I was the Springboks supporter, but I'm a bit torn. I really like the Springboks because of what's happening with this change in the side, and some of those guys where they've come from and what they did to get in that side. But at the same time, I think Australia needs these wins. I'm not really fussed. It was a good game.
All right. Thank you.
Tony agrees. All right. Well, listen, just before you go, James, I'd like to ask 2 questions. Number 1, if you had one piece of advice for people who are learning to become value investors, what would it be? And then secondly, I'll get you to just tell people if they want to check out your fund, what they should do.
I guess the most important thing I would tell people is do your own homework and trust your instincts. I think as a value investor, you must understand human psychology, and there is this thing with humans that you feel more comfortable in a crowd, and that's just how we've been made. So you've got to resist that and just do your own homework. and see if it stacks up. That's what my advice to a young value investor would be. In terms of us, our website's wentworthwilliamson.com.au. So we've got our deep value fund there. And we've also got a credit fund, which we lend money to doctors and dentists because they're a great credit. You'll find our value fund on there. And we've got our quarterlies on and, insight pieces and so forth on there.
Is there a minimum investment that you are looking for?
Yes, so we wholesale. So it's 100 on both. 100K on both.
Right.
Thank you.
All right. Well, thanks again for taking the time to chat. Congratulations on the fund and stay safe in Sydney.
Thank you. Thanks Cameron and Tony. Thank you so much for your time.
Well, that was nice. Nice fella. So let's quickly try and get some of the questions done. This first one is from Duncan. He posted on Facebook on the 14th of September, so it was last week. But does anyone have any idea why BLX fell nearly 7% today? You familiar with BLX, Tony?
Yeah, Beacon Lighting. Yeah, I'm not sure either, but it did go ex-dividend on the night, so that could have led to some of the selling.
Right.
But yeah, don't know, sorry.
So this is
not familiar with it enough.
Part of this thing you've been talking about recently where we have to factor in dividends going ex?
Correct, yeah. Yeah, not just the dividend itself, but I think, as I said before, sometimes they just keep on selling because if they were holding it for dividend reasons, not capital growth reasons, they're prepared to sell and move on to the next dividend company.
Yeah, dividend harvesting, I think you called it.
Yeah. Mm-hmm.
Yeah, I looked at BLX. I think at the time, I'm just going to try and find this post. Yeah, I did pick up the dividend at the time. So the dividend was 4.6 cents and the ex-date was the 10th of September. So...
Well, I'm just looking at the share price now in Brett's spreadsheet and it's almost back to what it was at the end of August. So it's 1 cent shy of that. So it's whatever happened, it's righted itself again.
Right. So, again, just the lesson for all of us is keep an eye on those dividend dates.
Yes, and factor in if you're a shareholder, you're receiving that dividend, even though it hasn't hit your bank account yet, so factor that into your calculations.
It would be really nice if Stock Doctor could throw those on the chart so we could see what is going on.
We could ask Brett, but I think he's done enough work for us this week.
All right, good one. Leo on Facebook bought CDM and then on the 12th of the 9th and on the 13th of the 9th he went, ouch, 10% down today. I'm going to wait and see if it bounces back tomorrow. Hard to decide on rule number 1 when just bought. Sell line is still holding on. Any thoughts?
Yeah, so again, this is a Cadence Capital, which is an LIC. So I actually have been taking it out of my downloads because it's an LIC. But just digging into it a bit, I don't think it pays a dividend. I'll just have a quick look for it on Stock Doctor. So it may not be dividend related in this case. The first thing I always look at is when it went ex-dividend. Oh, sorry, this one does pay a dividend, but it hasn't been paid yet. 18th of October is the next dividend. So I don't think it's dividend related. But I did notice in some quick research I did today is Cadence has something like 18% of its portfolio invested in a NASDAQ company. TMC is the code, which listed on the NASDAQ. And I noticed that it's been quite volatile and did go up when it listed, but it's dropped down again. So that could be behind the movement in Cadence's share price.
Well, I guess he bought it, I don't know when he bought it, but because it looks like the 12th was the weekend, I think. Yeah, 13th was Monday. Closed on the 13th, sort of around about $1.20. It's currently at $1.16. I did just notice that on the homepage of CDM on Stock Doctor, it does have this next declared ex-div date thing in the box number 2 there under star income criteria. Is that normal? They tell you the dividends there? Is that where you find it?
Yeah, so that's where it says the next dividend date. So in this case, it's helpful because it's coming up. But if we look at a stock that has declared a dividend, it'll have the date being March next year. So if you want the day that went ex-dividend, you need to go into the financial statements and then go down to the income section and you get the ex-dividend date there.
Right. No easier way to find that, huh?
No.
And one thing that you pointed out to me this morning is with these licks, taking them out, is that you actually take them out of your spreadsheet when you identify
Correct.
a lick. So it doesn't show up the next time.
I take them out of manually. I take the ETFs and licks out of manually into data so that when I do a download, Cadence Capital, for example, comes up with errors when it tries to find it in the manually entered data sheet. And I just know straight away then it's an ETF or a lick, and I just delete it.
Right. Yeah. What I did with this morning for another one is I just color-coded it red, so the next time it'll show up as that, and I'll know that there's something fishy about it.
Yeah, and look, to be fair, definitely with the ETFs, after I had a look at those, their operating cash flow is driven just almost solely by buying and selling in the ETF itself. LICs are a little bit different, so when I get some time, I'll try and do some more research and just decide whether we should add them back in as operating companies or whether we just put them in the ETF bundle and leave them out.
Yeah, okay. Thanks. Daryl on Facebook asked about EHL. He said it seems to have re-established its uptrend and over QAV score of 0.24, but it's not on the latest QAV scorecard at all. I'm not sure if that was one of the ones that we looked at this morning.
Yeah, it's a Josephine, and so is ABA, the other one he asked about.
Right.
So that's why they were deleted from the buy list. But have a look. I think you're putting out a more detailed version of the buy list too. The summary one has the Josephines taken out.
Yeah. You're
also putting out the more detailed one, aren't you?
Yeah, well, there's in the same sheet. So there's the first tab is just the short buy list. Well, that's not so short when you do it. It's like 36 stocks, I think, this morning. The second tab is the unfiltered list where it has all of the scores and whether or not it's a Josephine, et cetera, et cetera. So if people are wondering about that sort of stuff, go to the second tab and you can find out.
Right. Yeah, so Amico and ABA will be in the second tab then, but they've just had downturns recently, which is why they're off the buy list.
Okay, thanks, Daryl. And since Tony already uses an SMSF, self-managed super fund.
Avocado.
Say what?
Avocado.
Avocado.
Avocado. SMSF.
Can he impart any knowledge on how to ensure there's no issues with the trust deed for investing QAV style? Any traps, tricks or thoughts on having an individual or corporate trustee, how long he would spend himself beside accountants, etc., and ensuring everything is done by the book, and what that process is for him monthly and or annually?
Yeah, good question, Ange. I think the first thing to note is in our SMSF, we only invest in shares. So we're either holding a little bit of cash or we're fully invested in Australian shares. So that might be different to your SMSF. So this is general advice and not specific, but our SMSF is relatively simple because it's just holding shares. But I guess one of the important documents you'll need to address is the strategy plan. So if you're the trustee of your SMSF, you need to lodge a strategy for how you plan to invest the funds. And in my case, historically, it's been a very simple strategy. It's just saying the fund will hold somewhere between 0 and 100% in Australian shares and 0 and 100% in cash. I think I did get a question last year. I think the ATO doesn't like that. So I think I've now had to say 0 to 90% in shares and 0 to 90% in cash. But anyway, your accountant can help you with that or your auditor can help you with that. I don't know what's in your SMSF. You may already have some other assets in there. They may be shares. They may be property. You just need to take all of that into account when you're documenting your investment strategy. So that's the first thing to be aware of. The second thing is you asked about whether we have a corporate trustee, and we do. So it does add an extra layer of cost because because it's a corporation, you have to register it with ASIC and then do the return every year, which is very simple. They send you an email and say, give us $450 and if nothing else has changed, we'll just keep your registration going for another year. So that's a cost. But in corporate trustees versus personal trustees, and I've been both, there's not much difference in them. Corporate trustee gives you a bit of flexibility. So if you want to add new members or delete members, it's easier to do it with a corporate trustee. And it's got something from memory to do with the way the assets are registered. If you're a personal trustee for a super fund, the assets are held in your name. I think from memory in trust for the super fund. Whereas if it's a corporation, they're owned by the corporation in trust for the super fund. And that just means, again, if you're a personal trustee and then want to change the trusteeship, give it to a spouse or somebody else to be trustee for you, there's a bit more admin in terms of reorganising the ownership of the shares or the assets in the fund. So a corporate trustee helps from that point of view. What else can I say? In terms of extra workload, no additional workload. It's another tax return, so again, there's a bit of a cost there. Obviously, you have to audit the super fund, which is another cost. And then, they'll send you the paperwork to file. But that's about it. So no additional ongoing work for me. I don't do anything differently in terms of investing for the super fund compared to my family trust or personal names. So no additional admin there. I would say if you're not familiar with being a super fund trustee or in running your own super fund, there's certainly some, sort of how-to guides which are out there. Again, I got one from my accountant when we set up the SMSF. I think the ATO has a guide. There's a few rules you need to be aware of. They generally don't come into play. A couple of ones that spring to mind. We went overseas, and if you're an overseas resident, you can't be a trustee for a self-managed super fund, or you can't control the self-managed super fund. It has to be controlled by an Australian resident. And I think there's time limits on that. So we did a bit of finding a different trustee for the fund in that circumstance, which, again, it's not that difficult. It's a bit of paperwork your accountant can fill out for you. There are some other rules you need to be aware of. Probably the most prominent ones are related party transactions. So you can't, for example, buy an artwork in your super fund and then go and hang it on the wall. You can invest in art under certain circumstances, but it's got to be on a commercial basis, and it's got to be then rented out somewhere else or hung somewhere else other than your own personal house or your own commercial premises.
In my house.
And you could do it in your house, yeah.
Yeah. Okay, if anyone...
Ideally, you should pay a rent for it, and that way it becomes an asset that's providing an income for the super fund, but yeah.
I'll pay $1 a month.
So that's the thing. You can't... There are rules around, if you already own the asset, you can't... It's got to be transferred in at the right value, so pretty easy to do with shares if you want to transfer them in because you get a transfer price on the day. Difficult to do for artworks or even property sometimes. And also, too, the third thing I wanted to say is there are the contribution rules. So if you do transfer shares that are held, say, in your own name into the super fund, you've got to make sure that they fall within the contribution limits because you'll be taxed along the way and potentially fined if you've gone over the contribution limits for super funds. And I think from memory in your case, Angela, it may not be an issue, but if you're an employee of a company, they may already be making, or they will already be making, contributions to your super fund for you. So, yeah, transferring shares in may be an issue for you. But again, if you talk to your accountant, they'll work it out for you. But I think they're probably all the only issues. There are a whole heap of issues which we haven't encountered yet, which is the retirement side of things. So once you get to a retirement age and the superannuation rules flip, and there are rules around paying yourself a pension and how much you have to distribute from the fund every year. But until then, it's pretty straightforward. And what else can I say? There are benefits to it. So tax benefits on the way in, paying much less tax on both on dividends and capital gains tax compared to any other structure that's available. And then, of course, once you reach retirement, you're paying no tax on those assets, which might be good for you as well. So benefit. On the downside, once the money's in, that you can't get it out. So you can't decide to sell a share and then go and buy a piece of property in your own name or something like that, or pay off the mortgage for your house. You just can't do it. It stays in the super fund. So just be aware of that too.
Haven't you been retired for like 20 years?
You can, under some circumstances, write to the ATO and say, look, I've been retired for 20 years, and as long as you never have employment again, you can get access to your super fund, yeah. Or if you're being disabled or something like that, and apply to have it released early. But yeah, it's pretty rare.
But I'm talking about, you said you haven't dealt with that yet because you haven't hit retirement. You've been retired for 20 years. What's retirement look like for you?
Yeah, I did think about writing to the ATO, but no.
I've been working you harder than you've ever worked. Well, for 20 years right. In the last few months. Yeah.
Correct, yeah.
All right. Thank you, Ange. Thank you, Tony. Max, he says he's surprised you increased your position in NAB recently, considering it was so close to such a steep sell line. I know we cannot forecast, but such a steep sell line would really put the odds against NAB staying above it.
Yeah, what can I say? I'm a thrill seeker.
Buying it, National Australia Bank.
I think the hard thing for me in the last little while is just finding companies big enough on the buy list for me to buy. So, right. Yes, Max may be right, but NAB may well cross its buy line any day now if it hasn't already today because the market's down. But yeah, I bought it because I had, it's pretty much the only other option for me to buy.
Right. You're limited in what you can buy.
Yeah. Yeah.
Mark on Facebook asked, does anyone know why WAF is dropping? Can't see any bad news, no dividend either. I'm considering dumping it as rule number one. It's WAF story.
Yeah, so I own West African Resources too, and I think the clue is in the name. There was a coup in Guinea, which is in West Africa, and the West African mines that we're talking about here that belong to WAF are in a neighbouring country called Burkina Faso, so they haven't been affected by the coup, but I think just people have conflated West Africa and coup and gone, let's get out of overseas mining. So the downturn in WAF occurred the day after the coup, or it started the day after the coup, so I think that's a lot behind it, but the gold price has been declining slightly too over the last month or so, which is also driving it. And yeah, like Mark, it's also getting close to a rule one sell for me, although the company's well above its sell line, just generally.
Right. Yeah, no, it seems to be way above it. It's I just had a quick look.
Yeah.
Okay.
Yeah. I think it's more likely the gold price will be a sell before WAF is a sell, but who knows what will happen with the gold price.
Right. Well, I've got a question in here from Luke about about the sell line for Zimplats, but now that we have the Bretelator, everyone should be able to answer sell lines for themselves now, right?
Yeah, although I think what Luke's alluding to is the fact that it's a commodity and would I do a fudge? Because the sell line for Zimplats is reasonably flat and a long way off where the share price is now. So I'll just quickly give those. I'll use what do you call it? The Bretelator? The Bretelator?
Sounds
like a coffee percolator.
Not a breathalyzer, a Bretelator.
A Bretelator. So I'm getting 31st of October 2017 as L1. Or I shouldn't say I am, Brett is. And then 30th of September 2020 at 8.99 as L2. They're the sell lines for Zim. And that gives us a sell price of $10.74 when the share price is currently $20.49. So it's a long way off. I think what the question is asking is, did I want to fudge it and start with the L2s and go up?
Right.
But I don't, and I'll tell you why, because Luke needs to have a look in Stock Doctor. There's a commodity share price for platinum, which I'll just call up, and Zimplats is obviously a platinum miner, I guess. I don't know. Do you mine platinum? Or do you refine? I'm not sure. Anyway, XPT _ is the physical platinum graph in Stock Doctor, and it's a 3-point trend line sell. In fact, it crossed it a month or so ago.
Right.
Crossed it about sometime, towards the end of August. So, Luke, regardless of what the sell line is for Zimplats, the underlying commodity is a sell. So if I owned it, I'd be selling.
One of the commodity sells. All right.
Correct, yeah.
James on Facebook said, I see copper futures TR hash prices heading in the right direction and increases my interest in C6C and other copper miners. Got any thoughts on where copper's at this week?
Yeah, I've been watching it almost weekly, if not daily in some cases, because the futures have been trending up. The buy, so I use copper physical to base decisions. The futures are a good trend for us as to what might happen, but in every other commodity case, we use the physical, so I'm going to use physical for copper. It's just touching its buy line. So if it goes up further from here, I think it's going to be a rebuy. We did sell stocks off a little while ago when it became
C6C, yeah.
Yeah, but if you have a look at, I did go back and look at C6C, and Samphire was the other one that I sold personally. They're still declining, so I'd feel uncomfortable buying C6C, for example, even if the copper price does turn up, if the share price graph for C6C is still going down, unless you're going to do like an average down or something, as we were talking about with James before, you might be getting in a little bit too early. I would expect to see the share price graphs turn up once the copper breakout happens into the buy going up. But if you look at C6C, for example, it's still well and truly into its buy territory, but it's a Josephine. It's a falling knife at the moment, so I'd want to see it turn up a little bit before I bought.
Right. So I'm just looking now at XCU _, the copper physical. How are you drawing the buy line for this one? Because we had it as a sell. If I do just recently, obviously, if I do the buy line follows the sell line.
Yeah, so the sell I've got crosses 31st of August, 2021.
Yep.
So then the buy line I go back to May 2021 for H1 and then July 2021 for H2.
Right.
And if I draw, it's just it's around the current price. It's just almost touching.
Yeah, okay.
So it hasn't crossed up yet, but it may, given the way the futures price is going.
Yeah, but it's still below the sell line. It'd be a Schrodinger.
Sell price was 9388. Oh, I see what you're saying. It's below where the sell line extends.
Yeah.
Yeah, it would be a Schrodinger. You're right.
Does the Bretelator handle commodities?
It doesn't, unfortunately, no.
Okay. Yeah, okay.
I think from memory it only handles 3-digit. Well, it might handle more than 3-digit ones, 3 alphanumeric codes, but it doesn't handle these commodity ones.
Right. But yeah, okay. So copper would need to pick up and get above that sell line for us to start rebuying things like C6C.
Mm-hmm. And also too, I think the C6C share price would need to turn up as well.
Yeah, right. Well, that's all the questions that we have down for this week. After hours, you've been watching more Happen Leonard.
Love Happen Leonard. Man, that was a great discovery. Jenny loves it too. Season 1 is really violent, and sort of in a Tarantino style, I guess, a bit cartoony, but it is very violent, so I'll warn people. But Season 3, God, that's good. That's a great show. Good. I'll have to check it out. Loving it.
And you've been reading some Stephen King, you said?
Yes, I have. Yeah, a new book from Stephen King called Billy Summers, which is good. It doesn't fit the mold in terms of the horror genre. It's a tale about a hitman eluding the mob, which is quite interesting and well written.
Oh, wow.
Stephen's a great writer.
Wow.
Yeah.
Well, from my end, I've mostly been watching Norm Macdonald YouTubes for the last week since he passed away. Chrissy and I have been doing deep dives on Norm Macdonald every night after we finish our Italian, and we've got half an hour to sort of turn our brains off. I been a big fan of Norm for decades. And funny, I had been watching a lot of his clips before he died. I follow a couple of TikTok channels where they just post Norm Macdonald clips. So I've been really enjoying him. So that was shock and sad to see him go so young.
Wasn't it? Yeah, definitely.
Mm. And in terms of reading, I've been rereading Shantaram. You ever read Shantaram?
Oh, no. Yeah, I've got a copy, but I just haven't gotten around to reading it.
It's been sitting on your desk down at Cape Shake. I saw it down there. Yeah, that's right.
Yeah.
Yeah, so I think this is my second or third time reading it. I just wanted to get into some sort of, deep poetic story outside of all the other history and political stuff that I read. So, been enjoying that. It's good stuff.
Good. Yeah, I remember you recommending it to me, I think when we first met. So
yeah, probably.
I must admit, I get daunted by the book. It's a bit of a tome.
It is a tome, yeah. And then he's got the sequel that came out a couple of years ago, which is another tome on top of it. But
right,
yeah, like I probably remember, I picked that book up, the first one, in a second-hand bin at St. Vinny's or something. Literally the day I was jumping on a plane to fly to Corsica to do the Napoleon event with Markham 13 years ago, and it was this. I read it on the plane. It was my plane reading, and I was sort of halfway through it by the time I got there. And it's this great romantic story of an Aussie who escapes from prison. It's loosely based on the author's real life. He escaped from Pentridge, I think it was, went on the lam and ends up in India, where he meets, among other things, and he gets involved in the drug trade, and he works in a slum as a doctor, and he has this incredible story. He ends up meeting this exotic woman. I think she's an American, and, she becomes his crazy love of his life kind of thing. And I was reading that, and then I met Chrissy, this American girl in Ajaccio, when I wasn't escaping from Pentridge. Maybe escaping from a marriage, but not close. Maybe. Anyway, so I gave her the book then after I finished it while I was in Ajaccio. I said, you've got to read this, which she did. So it sort of plays a big role in our story as well. So it's always nice to go back and reread it. All right. Well, that's the show. Big long one. Thank you for hanging in there, TK. Have a great week, everybody. Tony, stay safe. Enjoy your newfound freedoms. When are you going to go play golf?
I'm hoping in about a month's time. The golf courses are open. You can only go to ones which are 5Ks from home, which is not the one I'm a member of. There's 2 municipal courses within 5Ks, and they're both always completely booked out. So I don't think I'll be playing golf until I can get to my own club. Just in hopefully a month or so.
Just stand out on your deck and hit some balls over the fence on your deck.
Yeah, it's pretty quiet. I won't hit anyone.
Full 36 stories down and land in King's Cross somewhere. Yeah.
Yeah.
Just use the
the Coke side.
the QAV golf balls. Just knock them over and do a bit of advertising.
Yeah, I think I've used one of those. Like since you got them in lockdown.
Timing. All right. Take care, mate.
Anyway. All right. Thank you. Bye.
QAV podcast is a production of Spacecraft Publishing Proprietary Limited, authorised representative of AFSL 520442, AFS representative number 0012922718. Please don't make any investment decisions based solely on listening to this podcast. This is presented as general advice only, not personal financial advice. We don't know your personal financial circumstances. Please see a financial planner before making any investing decisions.